Welcome to the Planning for Life podcast with certified financial planner professional Russell Jacobs and financial life advisor Carl Coolidge. Carl and Russell will share creative strategies and ideas for overcoming challenges in your personal and financial life. Inevitably, life happens, and we will empower you to reach your destination. Thanks for joining us. Now, on to the show.
Hello and welcome to another podcast with Carl Coolidge. Today, we are going to address something that we hear a lot from clients and prospective clients, and really just a lot of people around. They want to know more about what the saying transferring risk means, because a lot of people think that transferring risk is only something that you can do with an insurance company, but there are other components of transferring risk, and that's one of the things that we're going to talk to Carl about today. Obviously, the insurance component, but also how does financial planning and some of the other techniques that they do at the firm can help you transfer risk. So, Carl, welcome to the show.
Thanks, Matt. Glad to be here.
Well, brother, let's dive right in. And can you define what transferring risk means?
Well, to me, a transfer of risk is just simply, taking liability off of a person. And again, in a traditional sense, probably most common to everyone would be like your automobile insurance, where you say, and again, you have to have it. So I guess that's a little different, but where I'm paying X premium per month and I'm transferring the risk of something catastrophic happening to me or my vehicle or me running into someone or whatever that may be. And so really that transfer risk is just simply saying, I'm willing to pay a premium to provide some sort of leverage, because that's really what the transfer is you're leveraging the insurance company to say they have much deeper pockets than the individual does. And that allows me to, be able to pay for it in a manageable way. Although, car insurance can be rather pricey sometimes, and it's no different with life, disability, long-term care, homeowners insurance. They all have the same concept of transferring that risk to someone else with a deeper pocketbook.
A deeper pocketbook and a larger pool, right? So that's right. The other big thing here is making sure that the way that they're able to transfer the risk is they're transferring the risk across a much larger segment of the population. One of the things that, as we were preparing for the podcast, and I've heard other people say this, is, the insurance companies never lose because, they've got these hardcore mathematicians who are always really looking at, how are they going to maintain the right levels of profit to maintain the insurance companies, bottom line, and to make sure people are employed. But don't clients win too? Doesn't the general public win when they transfer this risk?
I think they do. I do think insurance companies sometimes get a bad name because, as you said, I think that's more in the health insurance world where they're viewed more negatively, and that's a whole different animal that we won't get into. But I think both win because what you have is you're able to pay a premium, as I mentioned earlier, to transfer that risk versus having to totally self-insure it. So an example, you go out, you're driving your car, you get into an accident, you've totaled your car. Again, is it going to take you $20, $30, $40, $50,000 to replace your vehicle? It absolutely will these days, versus you paid X premiums over the years, and then you have to pay some sort of deductible, and then you get your car replaced. And again, I know it's not exactly that simple, but so I think where we as the consumer wins is from being able to have a manageable cost to transfer that risk. And yes, the insurance companies are built around numbers. They have actuaries, teams of people, as you said, and they don't do anything haphazardly. They're coming up with these numbers, from historical data, from looking at, what age groups, how they affect different things. And that's true with all the various insurances. So I think it's a balance. I think you can both win as a consumer and as the insurance company. And that's why, again, just an example on the term insurance side, what a lot of people do. It's a very inexpensive way to get the coverage that you need for your family. And so I I think the last stat that I saw was about 98% of term policies never pay out. And so you can say, okay, 98% of the time, the insurance company wins. Well, they've done that math and they know for the different demographics, the different age groups, male versus female, et cetera, where they feel they can price things in order to still be beneficial to them and you as the consumer. So again, it's, that's just one of the transfer of risk that we're talking about.
Well, so term insurance is something that a lot of people are a lot more familiar with because, heck, you can buy term online for, pennies, literally tenths of pennies on the dollar. Right. But I'm going to break down a couple of other life insurance things that I don't think a lot of people really truly understand or understand the value of. And let's begin with the flip side of term, which would be permanent life insurance. How does that work when it comes to transferring risk? And yeah, if you don't mind, can you just unpack that for us a little bit?
Well, as you say, with term insurance, and I'll talk about both as I think it'll help kind of, show the differences. Term insurance, the analogy I've heard quite a bit used is like paying rent. If you go rent something that you're living in, you pay your monthly rent, and then when you move out, you have nothing, you just leave and you move on to something else. But you don't have any of the responsibility that comes with issues that may occur. If the roof leaks, the air conditioning goes out, et cetera, you're just simply a tenant paying rent. That's similar to how term works, is you can get different lengths of term, most common 10, 15, 20, and 30-year level terms, where their insurance company is saying, if you pay X premium, as long as you pay the premium for this length of term, we will provide you with the life insurance. And so no cash value, no buildup of anything, just a very straightforward process. On the flip side, with permanent insurance, the premiums obviously are a good bit more than they would be for the same type of or the same face amount of a term insurance policy, but those build cash value over time. And so there's, again, different types of permanent life insurance, whole life, universal life, index variable life, traditional variable life. So I won't get into those specifics, but those are just different types of coverages out there. But they're priced very differently, or that risk transfer is very different because the insurance company knows at some point someone will get paid this death benefit. And again, that may be a spouse, it may be children, it may be a charitable organization. It really doesn't matter where it's paid to. But again, keep in mind, as I said earlier, on the term side, they know there's a very low likelihood that they're going to pay out a death benefit. On the permanent side, they absolutely know they're going to pay out a death benefit at some point. So therefore, they price it accordingly. So they feel like it, again, is good for the consumer, where they can build up cash value. They can use it for a lot of other things while they're living, but they know there's going to be a death benefit paid, obviously, once that insured passes away.
And you just really, opened up a huge can of worms that our listeners need to understand, that the level of complexity when it comes to life insurance pertaining to a death benefit, that you do need to sit down with a financial professional and really have a deep conversation on what your needs are, what sort of multi-generational needs that you have. Are there charitable needs, tax needs? There's a lot of different conversations. So please make sure that you don't go into those conversations without meeting with somebody with a lot of experience.
Yeah. Sorry, Matt. Absolutely. Yeah. I mean, that's the real focus of how we bring it back to planning every time. I mean, that's what we're really trying to accomplish with the plan, is we want to have a rhyme or reason as to why you need the coverages that you need. And so, to your point, there is so many different variations and types and what the needs are for. And again, you mentioned online, and certainly people can go that way, but we feel it needs to be done with a professional, with an advisor who really is looking at your entire situation, a la through a plan, which allows you to say, okay, with all of these different, bits of information that I plugged into my plan, I can see the levels of insurance that I need, and I can see, the disability, the long-term care, all of the other angles, and really gives me a reason to understand why I need that.
Well, let's talk about disability because it's unbelievable to me how few people purchase disability policies. Would you mind unpacking that for us?
Yes, it is a difficult one because I think a lot of people don't think that disability will ever happen to them. They think they'll just continue to go on, or depending on the level of disability they may have, that it may not become a big deal. But I heard I guess the best description of it long ago in the beginning of my career. And they said, okay, imagine you have a money machine in your garage. It just sits there and makes money throughout the day. Throughout the night, it works the entire time. So the question is, how much money would you pay to insure that? And the answer is, if I had a machine making money, I would pay as much money as I could to insure it. Well, how you have to view that is you or your spouse or both of you are the money-making machines, if you will, in the family. And so what you want to look at is it worth paying a small premium? And usually it's a very small percentage of someone's income to insure that money machine. So in essence, you're insuring your income and your potential. Because I think what a lot of people forget about is they just focus on the disability. If that occurs, then that can stop, obviously, the money flow. But that also stops all of the savings that you're doing through your retirement plans, through other investment vehicles. If you have children, it stops that college savings. So it doesn't allow you, if you stop making money, to pay your mortgage or to pay rent. So all of a sudden, it's not just, okay, my income's gone. It doesn't allow you to do all of these other things that you're accustomed to doing. And so to pay a very small percent of your overall income to insure, again, transfer the risk to an insurance company, that you're able to maintain a similar standard of life to what you were before you were disabled, I think is very, very important. But it gets overlooked a lot. And again, that's why we look at it in everyone's retirement or in everyone's financial plan that we do.
Sure. Well, let's continue on along the lines of planning, because I prefaced the podcast today talking about how there are other ways to transfer risk, and really looking at the overall components of a financial plan makes a huge difference. One of the biggest risks that I think, well, it's not me, I mean, it's written everywhere, that most retirees are concerned about is longevity and illness in their senior, what some refer to as the no-go years. Can you walk us through the planning process and how you, one, have that very difficult conversation? I mean, it seems strange that it's a difficult conversation, that you're going to live longer,
Right.
but can you help us with that?
Absolutely. So again, through the planning, part of what we're looking at are those longevity or long-term care needs. And so from our viewpoint, it's, there's one of two ways, again, to cover that risk. You can self-insure. And what we mean by that is you're assuming you have enough assets or sources of income, whether that be pensions or investment income, real estate income, things along those lines, where you can cover your long-term care cost for whatever that is. And again, they vary from what part of the country you're in, but none of it's particularly reasonable in my estimation, but it again depends on where you live and what kind of facility or where you end up going or what type of care you need. And so you'll see that that's really, the initial transfer of that risk is saying, okay, am I going to self-insure it, as I just mentioned with my assets, or am I going to explore getting some type of long-term care policy that I, again, can pay the premium and let the insurance company assume most of that risk? Now, what's happened over the past decade are traditional long-term care insurance has not gone away, but it's definitely become much, much more costly, and they continue to reduce benefits. So again, a lot of people may akin it to health insurance, where my deductible keeps going up and they don't seem to cover as much. it's not that different with long-term care, but what a lot of these insurance companies that stayed in the long-term care business is that have decided, okay, well, traditional long-term care insurance is really not, going to work for us from a planning liability standpoint. And so we need to find other avenues. And so you'll see where there's now policies that are combined with life insurance or just other, again, I won't get into specifics, but other unique ways where you can get some long-term care insurance, but maybe coupled with other benefits. And so, it is a big conversation. It's huge for baby boomers. We've also seen it with some of our younger clients and their late 30s, early 40s, because they have parents who are now moving into that zone and they want to make sure they have it covered so their children aren't having to do what they're doing. So it's a big conversation, and it's something, like we say, you at least need to explore through your plan, and then you can determine if, that you feel like the cost benefit or value is there to cover that need.
Well, let's just say, everybody hopes that they're going to be very, very healthy and just, pass away gently in their sleep. But what about running out of cash, right? I mean, people who take their last paycheck that they're ever going to get when they retire, how do you address cash flow? How do you address running out of money? Let's say somebody lives to be 100 years old. How do you deal with that from a planning perspective?
You really have to look and see what type of income sources do they have available. Again, historically pensions were there to provide you income, obviously, as long as you live, whether that be 70, 80, 110, it didn't matter. Your pension would last the entire time. Well, pensions are, going by the wayside. There's very few that still have pensions, typically, government related workers, school teachers, a lot of times in churches and along those lines, they will have pensions still. So to me, it's really identifying through our planning, okay, what are the income sources? Do you have a pension? Are you going to get Social Security, which I think most people will, and at what level? And then it's looking at your other assets to say, okay, how do we need to structure these in coordination with Social Security, with your pension, to ensure the best we can that you're not going to run out of money. And a lot of that goes back to expense management is key, liability management. So as they're getting closer to retirement, trying to reduce those big outflows like house payments, car payments, etc. And so it's a combination of all of those things. So unfortunately, Matt, it's not a simple answer, but it's really a combination of managing those liabilities or expenses, looking at all the resources or income resources and trying to blend those together. And the expense management to me is one of the big keys.
If you haven't, as our listeners realize now that you should be taking a lot of time to sit down with a planner. People, we've seen these quotes all over the news that people spend more time planning their vacations than they do planning for something that could last longer than their working years. Sitting down with a financial planner and really breaking down, every aspect of what Carl's talking about today, the different things that Russell has talked about on the podcast. Those are very, very important conversations. They're critical conversations that might not always be comfortable. But the super cool thing is, with working with an experienced firm, they've done this hundreds of times. You retire once, they help people retire every day. Carl, closing thoughts on the transferring of risk and anything we talked about today.
Again, I think coming back to the plan and just adding to, one of your points or comments at the end is, what I say to everyone is, you can borrow money for a lot of things, but you can't borrow money for retirement. And so you really have to have a plan early on. And if you wait until 50, 55, 60 to get your plan, that's probably going to be too late. You really got to look into it earlier so you can have a roadmap to really get where you want to go. But you've got to find ways to be able to manage all of these different things that pull on people every day, because we all have, kids, we all have expenses, we all have liabilities, obligations that we have to deal with. So you've got to find the balance and be able to pull that in and say, okay, I understand today is consuming me, but I want to keep looking long term so I can get to a point where I'm not going to have to continue to work. And if you know how to deal with that, in your 30s or in your 40s, it gives you a much better opportunity to be on track long term. So again, we've used the word plan probably 50 times through this podcast, but it's really the key because, as you said, people plan that vacation longer than they plan for retirement. And again, with anything, and I know males don't do this, but you generally don't start putting something together without getting some sort of instructions. Now, maybe paper instructions are old school, but you watch a YouTube on how to put something together. Well, it's no different. You just don't show up and say, hey, I'm going to be at retirement. You've got to have some instructions or a plan to get there. And I just think that gets overlooked quite often. So really just focus back on that and again, if you feel like you can do it yourself, which I think is a challenge, just find tools, but have some planning or have some ideas of how you're trying to get where you want to go for retirement.
Well, Carl, thank you very much for walking us through transferring risk today.
Absolutely. Had a good time.
I think this is one of those podcasts that you as a listener should be sharing with your friends and family. And the reason why is because this is a very, very misunderstood topic. I think Carl did a great job today really winding all of this together and really showing you how all of these parts need to fit with the plan. Pass this on to your kids, pass this on to your grandkids. It's super easy to do that. All you have to do is click that share button below. This is vital information. And the more prepared, the more conversations you have about finance, and sharing podcasts like this is only going to make your friends, your family, and your longer financial life even better. So for everybody at Jacobs, Coolidge and Company, this is Matt Halloran, and we'll see you on the other side of the mic very soon.
The content is developed from sources believed to be providing accurate information. The information in this material is not intended as tax or legal advice. Please consult legal or tax professionals for specific information regarding your individual situation. The opinions expressed and material provided are for general information and should not be considered a solicitation for the purchase or sale of any security. Russell C. Jacobs III, Carl B. Coolidge, James Jacobs, and William Schwartz are registered representatives of and offer securities, investment advisory, and financial planning services through MML Investor Services, LLC, member SIPC, Supervisory Office, Jacksonville, Florida. Jacobs, Coolidge and Company, LLC is not a subsidiary or affiliate of MML Investor Services, LLC, or its affiliated companies.